Welcome to the daily update where I'll go over the action in the market for Wednesday, April 9th, and we'll see how things look for Thursday, April 10th. Okay, took about halfway through the day, but there was an announcement that the tariffs are being pared back. The market seemed to really like that, and we saw a pretty powerful upward move, up 9.5% for the S&P. And okay, is that mean that things are over now, that the market's just going to keep going up? Not necessarily. We're still negative. There's a lot of damage that's been done over the last week. And right now, this just looks like a bounce within inside of a bigger downtrend. But we'll just keep watching this. If we keep going up from here, then we'll see things gradually start to switch over and look more positive. We're getting more of a mixed picture now with the big upward move. So things are definitely improving, but it doesn't mean that we're back to looking positive, at least yet. Okay, so right at the open, and the markets were really choppy, and we're also really keeping an eye on the bond market right now. Interest rates are just shooting back up. They were at 3.99% last Friday. They're really going up now. We intraday we got to 4.5%. I mean, that's a huge move within less than a week, and that could be indicative of some things going on under the surface in the market. And we need to keep an eye on that because with the interest rates really going up, that means somebody's in trouble out there. They're selling, it might be hedge funds, it could be some mutual funds, and they're selling lots and lots of treasuries, which is pushing prices down and pushing interest rates back up. This is the opposite of what we were seeing late last week, where they were selling stocks and buying bonds as a flight to safety, and that was pushing interest rates down. So things are quite volatile right now, and there's still things that need to be worked out. But the futures, I was watching things pretty closely, and we would go from being down 2% to coming back to unchanged to being up 0.5% or 1%, back down to unchanged, then going negative. There's been some liquidity issues too in the futures markets, which are making the futures prices when the market's not open in the US, the cash market, the futures are just flying around all over the place, and it's causing these really big moves to happen right now. And you combine that with what's going on in the bond market, and I mean, people they like to think of bonds as being really boring and that they're always doom and gloomers because if the economy was getting ready to really run into trouble, bond prices would be going up as people are getting into bonds. But they're probably, as a whole, they tend to really understand and know more of what's going on with the economy. So if we see weird things starting to happen there, we want to be aware of that because of how it can affect the stock market. Well, all this gyration and interest rates flying all over, it ended up giving us a flat open, even though the futures were really gyrating all over. And we hit resistance at the daily pivot at 5,054. And then we declined back to the unchanged level. And then we just started this sideways chop. But it was a big percentage move. We'd be up about 1%, then we'd come down to the unchanged level. It didn't look that big on the chart, but because of the sizable moves that we've seen lately, it made it look more subdued than it actually was. And we just chopped sideways above and below the unchanged level there for a while. Then the announcement came out that the tariffs are going to be pared back for a little while. And the market seemed to really like that. It was more of a relief bounce. And then we just had this massive upward move, getting us above the daily pivot and R1 at 51.97. We got above R2 at 54.11. So we're well over the 5,000 level for right now. We're even over the 5,400 level. And we closed just a little bit above the 54.50. So we regained some ground, but our charts have not switched over to positive. Some are looking better, and it looks like right now that we're just working off this extreme oversold condition that we've had. So we were up 9.5%, 9.52 on, and volume just really went big. So we were well above average there. So even in the short term, we're still negative. We haven't recaptured the 20 period moving average. We're still negative in the intermediate term. We're mixed in the long term. We've got to get back above the 200-day moving average first, and then above the 50-day moving average. Because if that doesn't happen pretty soon, we're going to see the 50 period moving average come down and cross below the 200-day moving average, and that's going to turn the longer term trend to negative. And right now we're focusing on interest rates here, which means the bond market, and seeing if that can settle down. It's becoming part of pop news in a way, not not the head, because the whole talk about tariffs, even though people don't understand really what's going on, you can put it all down to one word, tariffs. Okay. And that becomes the source of memes and the source of opinions and everything else without really understanding the deeper meaning of what's really going on. It's a little harder to understand when it comes to bonds because there's more of an interaction type of a thing. There's more of a process that's a little bit more complicated, and that's causing the gyration. But in a few of the sources that I pay attention to, they're trying to explain this, and they're not involved in the markets. And so they're like, it's somebody trying to explain something that they really don't understand all that well. I'll be watching the charts. I'll be trying to dig in and find some information myself and see, okay, is this really causing a problem either in the short term or further down the road? Because we're seeing interest rates going up so quickly. Or is this just something that the market's working out to try to get a little bit of equilibrium going on here? And then that's going to actually help things become more stable. And then on Thursday, we're going to get the CPI report. That's the second biggest economic report of the month. But with everything else going on, is the market really going to pay attention to that? So, but we'll get a take on inflation in Thursday's session. And it's all, the trade wars, and it's really between the US and China, but then all the other countries are involved as well. And there's some positive things and some negative things that are developing there as this whole process unfolds. Okay, so President Trump announced a 90-day suspension on recently imposed tariffs, reducing them to 10% for countries that have not retaliated against the US. But China, no, we're actually going to raise your tariffs to 125%, where just yesterday we said they're going to be 104%. So they're playing hardball. Trump is really playing hardball with China. China's trying to play hardball with the US. And this is what we call a trade war. And now the one thing that kind of makes this not as drastic from a US standpoint is that, okay, that can hurt products going from the US to China, but we don't buy very much from China. There's really not an awful lot coming in from China to us. So that might help US consumers a little bit more, but it can hurt US businesses because of the increase in tariffs of things that are actually sold in China. Okay, then we did get the release of the minutes from the last meeting when the FOMC met. Really, the market didn't respond to this. This is right around the time that the announcement of the tariff delays or suspension came out. And basically, what they said is that the members generally saw increased downside risks to employment and economic growth. And that's what people are worried about. We're going to be watching the employment situation to see how that's holding up. We're also going to get jobless claims this week. We'll see how those numbers look. And they're concerned that inflation is going to increase. And there's a lot of uncertainty around, okay, what's this going to do to the economy? And so the market really didn't respond to that. They were responding more to the news of the suspension of the tariffs. And the mega caps really bounced up. They've been just getting hammered. But we're not back to seeing them taking a real leadership role. They bounced up and they're improving and their charts are looking a little bit better. But we need to see more follow through if we're going to switch back more positive, not just a 1 day bounce, as big as that bounce was. The VIX really dropped. We were into the 50 range after Wednesday, after Tuesday, and now after Wednesday, we're we're still above 30. I mean, that's still very elevated, but to have it come from the 50 range down to 33.62, that's showing an improvement there. But it's still, it needs to come back down under 20 to be more market friendly at this point. And we are starting to see a death cross. This is when the 50 period moving average moves below the 200-day moving average for the NASDAQ. We're not quite there with the NASDAQ 100, but this is changing the trend to down now. And it hasn't happened for the S&P, but we're getting kind of close. And it hasn't happened for the Dow. It's already happened for the small caps and the mid caps. So the one in my opinion, and probably what most people focus on, is the S&P 500. When that one crosses negative, because that's the benchmark and the foundation of the US stock market, if that switches over negative, then that's really going to change things. And if you watched the video yesterday, we had a very long list. Well, with the big bounce that we saw, a lot of this list got worked off, except some of our slower, more momentum-based indicators here, the slope oscillator, the MACD. We're still looking extreme with the rate of change based on 5 periods, but the 10 periods, the 20 periods, the other charts that I've been showing, they're off now. And the stochastics are still extreme. And we actually already have one overbought indicator. With the massive move that we saw up, the Stoch RSI is actually extreme positive now. And then our list is a bit shorter here in the intermediate term. We have the TTM squeeze. Even though it's starting to go back up, it's still extreme negative. Now, the 20 period exponential moving average, that's fallen off in the short term, but the 50 period for the S&P, it's still there. The rate of change more intermediate term, that takes a little longer to switch over. The Arun indicator is still extreme. The PMO and the studies, the Sean trend meter, and the bullish percent indexes, they're not as extreme as they were. We saw a nice bounce from the NASDAQ 100, but they're still negative for right now, but they are improving. And then we're still far away from the 50 period moving average. And the 200 period moving average is now dropped off the long term list. We still have the 150 period moving average that's still on the list. And no, the Fed isn't really involved per se in what's going on right now. So there's really been no change other than what we read in their minutes. And it's pretty much the same thing as the current scenario that we've been going with here. The dollar was up, interest rates are up. Again, last Friday we were at 3.99%. We're at 4.4%. We were actually at 4.5% intraday before coming back down, where after Monday, we were actually at 4.26%. So, I mean, this is a huge move. And this signals that something's going on to cause this because as stocks were going down, we saw interest rates going down. And but now interest rates are starting to shoot up a little bit here, quite a bit quickly. Sentiment is improving, but we're still below that 25 level. We had been at 4, okay, and we shot up to 17, but we're still below 25, so it's still extreme negative. And we're no longer inverted now with the 10 to the 3 month. We'll see if this adjusts and goes back to being inverted again. It's back to being more normal. We're still negative with our trend in the red line's coming down, the green line's coming up, but it's still negative, and it's still a strengthening trend because we're above the moving average. And of course, with the solid up day, we are positive with the bias, but we're still negative overall with the momentum taking the last number of days together. We just had a few reports that came out. The weekly MBA mortgage applications, it was up 20% on it from the previous week. It could be the drop in interest rates, where the week before it was down 1.6%. Wholesale inventories came in as expected, up 0.3%. Last time they were up 0.8%. And here's a chart of the mortgage applications where they've been negative overall, but getting less negative. And then they really shot up here in the latest reading. This just gives us an idea more on a real time basis of what's happening in the real estate arena. Okay, so valuations based on forward operating earnings. Now, this is before the 9.5% bounce that we saw here, but this is really coming down. We're at 18.63 here with the PE ratio, and then looking at what is the average forward PE ratio, it's between 15, right around 16 or so. So it's still elevated. And then this is probably going to go back up now with the up day that we saw. But this is just one way forward operating earnings per share. We look at this more as just the total earnings per share, which has dropped under 20 when you look forward at this. So it's more fairly priced. But the fact that we are coming down a little bit here is just showing that things aren't as overvalued as they were. And then stocks tend to do well once a new market, bear market starts. Well, okay, we're not necessarily in a bear market now. We haven't closed 20% below the all-time high set in February, and we worked a lot of that off in Wednesday's session. But this is right when we go in here, we saw the change, both the median and the mean, and then the day we moved into a bear market, this is the actual day. Now that day hasn't happened yet. And then when we start to go into a bear market, this is what it looks like: 1 month, 3 months, 6 months, 12 months, and 2 months out. I mean, it kind of goes against logic here, but that's what Carson came up with. And these are different V bottoms that we've seen throughout history. The latest one being the COVID plunge. We came down and we're able to bounce up out of that. Is that going to happen this time? We don't know yet. We did get a nice bounce on Wednesday. But is that just a dead cat bounce? We're just bouncing up before we're getting ready to go back down? Or are we going to build on some strength here and actually roll over and be more positive? But this just gives you an idea of different times when negative things have happened. And then when we were able to V bounce up from that. And then the Brett signal has activated. Brett based stock market bottom signal. This is Bloomberg here. They put this out showing that when we were really down right here, that just means we're extremely oversold at that point, and this often will bring in some buyers. And then we expect margin estimates will decline later in the year. Okay, fine. They have them coming down the median trajectory where the consensus of margin growth here, they think it's going to be coming down, and they do this from a bottom up consensus based on the earnings for the S&P. I don't know if you really get much out of this chart here. Risk appetite indicators for different classes, where the black line folks are still, they're more negative on stocks right now, but it's still one of the better looking areas. And then the dark blues, equity volatility. I mean, they don't like this, that we've been going down and seeing a lot of pressure on things right now. And so we're seeing all of these asset classes coming down quite a bit. And then this is the VIX of bonds. Okay, it's called the MOVE Index. And this is what's been causing some problems. It's really shooting up. Now, when I do the weekend videos, I do some studies with the MOVE Index. I compare the MOVE Index with the VIX, and we'll give it another day or two, and then I'll go over these in the weekend video. But when this is going up, that means bonds are going down and interest rates are going up as well. And it's just showing a real increase in the bond market. And again, this is before Wednesday's session. We're not that far down now, but we were down about 18.9%. And if we go down over 20%, that's when we officially go into a bear market. And then the recession probability, it's starting to go up. We'll see if things start to improve. This is likely to come down. But now there's about a little over a 60% chance that we're, according to JP Morgan, that we're going to go into a recession. All right, so here is the chart. And these moves that you see earlier, they looked small, but really they were quite big. We had pretty much a flat open after a wild night with the futures, where we got up to the daily pivot, we came back down, and then we went above and below the unchanged level. Saw a little bit of an improvement here, and then this is when the announcement came out. You can see a real pickup in volume on the bottom, and we just shot up above R1. We got up to R2, hit some resistance there, fell back, and then we're able to close back above it. This is better because we're seeing late day buying coming in. Now, some of that could be short covering, and this is when people that are short the market, they have to sell to get in because they think they're going to be able to buy it back at a lower price, and that's how they make money. Well, with this massive move up, these people are having to close out their positions. So if they sell to get in, they have to buy to get out. And that is what we call a short squeeze or a short cover rally. And that can push up prices, especially as we're going into the close. And so here, this is showing the gyration of the futures in this pink area and then in this light blue area here. This is how we were bouncing around all over the place, up and down and up and down. And then we were kind of moving along here with a massive up move. And we're down. I checked right before I started recording this, but it's many hours before the market opens. We're down about 0.8%. But if the futures are really wild, when I did the videos yesterday, I recorded one video, we were down 2%. By the time I got done recording that video, we were unchanged. And then I recorded another video and we were up half to 1% or so. Then by the time I got done recording that one, we were back down to unchanged. So, I mean, we've been all over the place. And we're seeing an improvement with both value and growth here. At some point, if things turn back more positive, we want the blue line to be outperforming the red line here. That means growth is outperforming value. And we are seeing some improvement here. This really big upward move. This was benefited by the mega caps and growth stocks. And that was one of the stronger areas as we were bouncing up here. So we are seeing some improvement, but we need to see this continue to go up because we have seen an improvement before, only to lose that and end up going down. So end of day, get this. Growth was up 11.29%. That's a huge move. And value was up too, but only a mere 7.54%. And for the mid caps, growth was up more. It was also up more for the small caps. But was this just a relief bounce? Or is this the beginning of a V bounce that we're going to come out of? That's what we're trying to evaluate right now. So we did see an improvement with small cap growth to value. We were able to get back above the 200-day moving average and the 50-period moving average with this ratio. Not quite up to the 50-period moving average with mid cap growth to value, and not even back up to the 200-day moving average with S&P growth to value. So this is improving, but we're in danger of seeing a death cross with this ratio. Bit of an improvement here, but still below the majority of the rainbow with this growth to value chart here. And we did bounce back up with discretionary to staples, but we're still below the 200-day moving average. And this is where the red line's coming down. We were getting a little concerned here because when any of these lines, whether it's the black line, that's the indicator itself, the ADX, the red line or the green line, when any of them get above 40, that's when we go, okay, this is getting overextended. The red line had been above 40, even though the ADX did not get there. The red line's now coming down. It's no longer extreme, but this is still a strengthening trend because we're above the moving average. Now, if we see this continue to go down, this will probably roll over, and that could suggest a weakening trend if that's what we see actually happening. And then in the short term, we were extreme. We were above 40 with the red line. We were also above 40 with the ADX, and we're still there in the short term, but we are coming down. Volume just was massive. It came in droves here. You can see how it really picked up there in Wednesday's session. And we're coming down here, which means that we're getting further away from bear market territory. We're still in correction land because we're down 11.19% from the all-time high, but we were getting very close to that 20% level. We've worked off some of that now, maybe giving us a little bit more time or at least a chance to possibly improve. All right, sentiment, we're still getting very high readings with the Ultra Index. This is a fear gauge that we look at. We're still getting high readings with the VIX, but it's really coming down from the huge readings we were seeing before. Also, the VIX of the VIX is starting to drop here. We're no longer extreme because we were going up really fast here with the VIX, and so the RSI was giving us an extreme positive reading. That's more back down to neutral based on the decline that we saw. But the momentum for the VIX is still up. And this fear gauge had really been spiking up. That's now starting to come back down. This other fear gauge is starting to come back down after it had been spiking as well. And the equity put call ratio actually ended up being down on the daily chart. We're ticking down just a little bit after we were really rising on the 5-day chart and also ticking down on the 10-day chart after we were starting to go up. Typically, when the 5-day chart and the 10-day chart are going up, that means the market's becoming more defensive. And with the big upward move, we worked a little bit of that off. Saw an improvement here with the risk on to risk off ratio, but still, we need more than just one day. We need to see this really start to climb back up and outperform. That would be more positive for the stock market. And we saw a bounce here with the high beta stocks. These are like Apple, Amazon, Netflix, Google. The stocks that tend to outperform the market when we're going up, but they go down faster when we're going down compared to the more conservative or even value stocks here. This ratio has just been coming down fierce. We did bounce from there, but we want to see more follow through to the upside for this to be more positive. And we're coming back down. We got to the high end of this band with volatility risk premium. With the big update, we're actually dropping down below the band. So a bit of an improvement here with our advanced decline line based on price. We never did cross below the moving average. We're coming back up, but we're still slightly below the moving average here with the advanced decline line based on volume. You can see these green areas in here just show massive movements up, both based on price and volume. And we came down, we were just on the border of being extreme negative with our advanced decliners over the last 10 days. And this works out to be an oscillator. So we look for extreme positive or negative readings. We were right down here to this green line, which we could still have gone lower, and we still could go lower from here. But with the upward move, this bounced back up, but it's still below zero. So it's still negative. And we really didn't see any improvement with the new highs. There were virtually no new highs that were generated, just less new lows. So this internal measure is still looking negative, although a little bit less negative since the red line is actually contracting a little bit. So we're going down with the 5-day chart and the 10-day chart. And we bounced back up, but we're still below zero with our advanced decline short-term and intermediate term ratios. We are turning just a little bit positive. We're barely above the moving average here. If we can get back above the red line, that would help turn things more positive. We're improving and actually starting to turn up. It's hard to see, but the red line is going back up as the histogram here has turned green. So our number one smart money indicator is just barely positive, looking barely positive here with the Chaikin money flow. And this is more positive. We had become extreme negative with the Chaikin oscillator, smart money indicator number three. And you can see other times we had really extreme negative readings. This produced some kind of a bounce. Whether it's going to turn into anything more than what we've seen so far, that's what we're waiting to evaluate. And we're still negative with the vortex, even though the red line's coming down and the green line's going up. And we did improve with our advanced decline line studies across all the different indexes, but all of them are still below their moving average, even the S&P. And we're coming back up, but we're still extreme with those stocks above their 50-period moving average. We saw an improvement with the 20-period moving average study, which I neglected to put that chart in this video here. But this is improving, but we're still quite negative. We're below this 20 level. Also, not extreme anymore with the 100-period moving average study, and going back above 30 with the 200-period moving average study. So this is interesting. When we came down here, what we did in Wednesday's session is we saw enough of an upward thrust to fill this gap. So that's helping the chart look a little bit better. Are we going to fill this gap and then turn and go back down? Or are we going to be able to continue to bounce up from here? And what I've been talking about with the trend, you can see how the blue line's coming down and the red line, they're getting pretty close to each other. And this is when we would actually switch over into a downtrend. Then on the bottom, we see the massive amount of volume that was generated. And we probably overdid it. Yeah, you don't get 9.5% moves in one day all that often. So we look at the advanced decline line percent. That's extreme. Doesn't mean we're going to go down necessarily. Doesn't mean we're not going to go down. It just means that we probably overdid it in Wednesday's session. And so we might slow down. Also, the advanced decline line ratio, also really, really high reading here because it was a big up thrust. We're no longer extreme with the 20-period moving average. We're turning up, but we're still extreme with the 50-period moving average. And we were just barely extreme with the 200-period moving average. We're no longer extreme there. And we're above the midpoint here with the Williams percent R, and we're already extreme positive with the Stochk RSI. We were just extreme negative, and boom, now we're extreme positive. That's how touchy this indicator can be. And we're no longer extreme with the CCI 14 or the CCI 20, just barely here with the 20 study. Coming back up, crossing above the midpoint in the short term, no longer extreme in the intermediate short term, just barely extreme negative here, but turning up in the long short term with our stochastics. The force index went from being way negative to actually going back to looking positive. And the condition of the short-term trend improving if we can stay above the blue line and the green line here. That would really help things, turning up just a little bit. But still, an awful lot of damage was done, and we need to see these lines turn and go up and continue to go up, not just flicker a little bit before we go back down. And with the 5 period rate of change, we really improved here, but we're still below this red line, so that's considered extreme negative. And we went from the way deep into the -3 trend standard deviations channel. We're just about back up to the midpoint. So that puts us at the -1 standard deviations channel. So this is improved too. And then this is a newer chart that I've been showing of what is inflation. Well, as of Wednesday, it's coming in at 1.34% according to Trueflation. This is a newer chart that I started to include, and we'll just have to see, okay, is there because we're going to get CPI is going to tell us what inflation is on Thursday. We'll have to compare it with what we see here. All right, then the balance of power still just chopping along around the midpoint. It didn't really see a big upward move. The go no go went from deep purple to lighter purple now. Still negative, but showing some improvement. And we're bouncing off of the lowest low value, but we're not quite back up to the midpoint. The TTM squeeze is improving, but we're still below this black line. This is also a longer term look at that same chart. We're still just barely extreme negative, but improving. And the 50 period rate of change, it's just barely still extreme negative, even though it also improved. And our standard deviation, this was really going up. That says we were coming down really quickly. Well, we ticked down just a little bit because this was a bounce in the opposite direction of us going down. We're improving, but still negative with the ease of movement. We're still extreme negative with the Arun indicator. We're no longer extreme negative with the S&P McClellan oscillator. We crossed back above this -60 level, but we're still negative since we're below zero. And so we're still going down with the summation index based on price and volume. We also improve with the NYSE McClellan oscillator, but still below zero. So the summation indexes for the NYSE are declining based on price and volume. So those are still negative. We're still declining. Even with the big upward move, the Swell and Trading Oscillator is still declining based on price and volume. Momentum, it's going to take a little bit longer. These are longer term indicators that take a while to shift. Saw a little bit of a tick up here, but we're still negative, extreme negative, and we're going down based on price and volume. And we were extreme with the PMOs that were rising. That really improved. Ticked up just a little bit, but we're still extreme negative with the buy signals, and we're still declining, but starting to level off here with the PMOs above zero. And we've gone from negative to positive with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. The dot is still on top. And barely starting to turn up here with the slope oscillator after being extreme negative. The MACD ticking up, but still negative and extreme negative right now. So on a momentum basis, we're seeing some improvements here, but they're all in the short, intermediate, and long term, they're still negative. And the Copic curve slowing down a little bit, could be extreme negative, but still negative nonetheless. Coming back up and just barely on the border between extreme negative and not extreme negative with the Sean trend meter. Still below 50 with the money flow, still below 50 with the ultimate oscillator, but both of those charts improved. We ticked up here with on-balance volume, but we're still below the moving average. And we're no longer extreme with the percent B indicator. We had been down here for 3 days. We worked some of that off as we're coming back up inside of the Bollinger Bands themselves. We're no longer extreme with the RSI 14. That's more intermediate term. And we're getting right back up close to the midpoint with the short term RSI 9. And a little bit of an improvement here that we were able to get back above the red line with our intermediate term trend, but not enough to even turn the lines back up. If anything, they're just slowing down a little bit. And we did recapture this couple of purple lines in here, these anchored moving averages. And we were only able to get back above this other one, which goes back to the October 2023 low. That's pretty significant, the fact that we were able to get back above that. Now the question is, can we hold it? And can we continue to go up and start tackling some of these other anchored moving averages up here? We're still below all the moving averages, though. The simple and exponential versions going from 20 periods up to 200 periods. We need to get back above this because the longer we stay down here, the more these lines continue to go down. We're no longer extreme when we measure how far away are we from the 20 period moving average, but we're still extreme with distance away from the 50 period moving average, improving but still negative when we measure the distance from the 200 period moving average. And really not much of a change here. We bounced up a little bit with the bullish percent index, but it's still giving us an extreme reading. And a little bit of a tick up here with the NYSE bullish percent index. This is where we saw most of it. And these are the mega caps, the real big stocks. But we're still extreme negative here. We had come down with a very, very negative reading for the NASDAQ 100 bullish percent index. So it's improving, but it still has a ways to go to no longer be extreme negative. And now it's kind of interesting. We're working off of one mass index signal. When we cross above the dash line, the blue line, and then come back down to the red line, okay, that's a signal. Now we're crossing back above the blue line again. And if we come back down to the red dash line, that would be producing another signal. And it's wearing off now, but the praying bottom fisher way back in March did generate a buy signal, but that hasn't worked out so well. It's been generating this buy signal as stocks have really been coming down. Okay, now we did recapture some retracement levels here with the Fibonacci chart. This is going back a year ago, April 2024, to the all-time high. We had lost all of this. We had pretty much given back all of those gains over the last year. Well, with that upward thrust, we're back above the 38.2% retracement level. So that's improving there. This is a longer term chart going back to the October 2022 low where we held up at this 50% retracement level. And that could be a good base to work from if things continue to improve. But with that upward thrust, we've now been able to get back above the 38.2% retracement here. So that's improving, at least on a Fibonacci basis. And we're back above this S1 level, but we're still below the pivot point here with our weekly chart of these pivot points. We had held on to this pivot point, broke below it, and we closed right at the S1. We started to go down below that. Now we've recaptured that. So that's improving there. And we are back above the midpoint here, the trend channel going back to 2009. We were able to bounce up. We were starting to fall below it. And this is an improvement. And this is a long-term trend line going back all the way to the 1987 crash. I don't have the big version here, but we were starting to fall below this trend line. We were able to recapture that again. So that's an improvement there. And this is another longer term trend line going from the October 2022 low, and then I draw that to the October 2023 low, and then just extend that line forward. This is a long-term support level that for right now has been holding. And looking a little more positive here with the Heiken Ashi, we're seeing an open candle here. And we're still negative, but pointing up with the Keiki chart. We actually turned back to positive with the Renko chart and looking a little more positive with the three-line break chart. So there is some improvement that happened here. And we saw some new X's drawn in here after seeing a whole bunch of O's. Some X's got put in here, plus some new ones on Wednesday. And now we have a low pole reversal, which is positive. This is like pole dancing going down, and now we're sliding back up here. Long term, we're seeing an improvement both with the 150 and 200 period moving averages. We crossed back above this line with the 200, but we're still below this line with the 150. So we're still extreme negative with that indicator. And we're actually switching back to positive in the short term according to stock charts. I still have us as negative because we're below the 20 period moving average. And they still have us as positive in the long term, where the mid caps and small caps are still negative across the board. The NASDAQ 100 went from being negative in the short term to being positive. And let's see. Apparently, I didn't show the other chart. I put both of these on here. Okay. Well, all the sectors ended up being positive. And this is good, but we need to see more than what we saw on Wednesday. The tech sector up 13.43%. Discretionary, another growth area, up 10.89%. Communication up 8.84%. Tech, discretionary, and communication. These are the three big growth areas. We need to see them take a leadership role, not just bounce for one day. And then healthcare, utilities, staples, real estate, they were up, but up less. And that means that growth was doing better than value, but we need to see follow through with that. And here we go with a lot of negative things happening right when the market opened, and then a whole lot of positive things as and I won't read through all these. Um, we were just seeing an awful lot of green here as we were going up. And we're still not at a death cross here with the Dow. We did come back above this S2 and S1 level, but we're still below the 200-day moving average. We've gone from negative to positive with the diamonds with the Elder's Impulse system. This is the NASDAQ. You can see where the blue line's crossing down below the red line. That's changing the NASDAQ trend from positive to negative. And even though we did improve, it was up over 12% itself. And we're positive with the Elder's Impulse system with a green bar with the NASDAQ. And we're getting close to a death cross here with the NASDAQ 100, but we're not quite there yet. This was also up over 12%. And we're positive with the Elder's Impulse system for the Qs, which is the ETF for the NASDAQ 100. We're still negative with momentum for the NASDAQ 100, but it is turning up. And this is where we've seen the death cross here with the small caps, the S&P 600. It did bounce up. This was up 8.84%, but a lot of damage has been done. This is the Russell 2000 small caps. We're no longer extreme with the RSI. We're still working off of a death cross here. Negative, but improving with the momentum. And we've gone from negative to neutral. I mean, you have an 8% gain and to only go back to neutral. Not really all that great there. Mid caps, recent death cross, so we're in a downtrend there. They did bounce up. They were up over 9%, but still below this S1 level that's acting as overhead resistance. And also going from negative back over to neutral with the Elder's Impulse system. The Wilshire bounced up. It was up 9.5%, a little bit more than that, but still not even back up to its 200-day moving average. And we were up 9.61% with the total US stock ETF, but also not back to the 200-day moving average. Financial sector did get back above its 200-day moving average, and that's encouraging. It was up 7.5%. We were really starting to lose some longer term support here. The fact that we got this back is encouraging. We need this to continue to go up and get back above the 50-period moving average. The FANG index bounced up. It was up 13.64%, but still not even back up to its 200-day moving average. And so Apple was up 15.33%, but we're seeing a death cross here, and we're still well below the 200-day moving average. Amazon was up almost 12%, but not even back up to its 200-day moving average. We're getting close to the 50-period moving average with Microsoft, but this is in a downtrend. So this is the moving average that would come first. We need to get above not only the blue line, but the red line, and then stay above that for this to turn back positive. Google was up 9.68%, seeing a death cross here, not even back up to its 200-day moving average. Meta did reclaim its 200-day moving average, and this trend is still staying together a bit better. Nvidia, which is in a downtrend, still not back up to its 50 or 200-day moving average, even though it was up 18.72%. All right, Tesla was up 22.69%, still not back up to its 200-day moving average. Netflix, one of the also better looking charts right now, above its 200-day moving average. It was up over 8%, but not even back up to its 50-day moving average. And then we're still seeing a stronger correlation between US and world stocks on a short-term basis, and it's starting to get stronger on a longer-term basis as well. And we did come down with our staples to tech ratio. This had really been going up. That's negative. This coming down would be positive. But we need this to keep going down. And we've seen a recent golden cross here with this ratio, which is more negative for stocks as they've been getting more defensive. Oil, it did go up. We're getting into the low 60s. Now we're at 62.35. And the dollar was up, but still below its 200-day moving average. And we're really going up here. See how we were just coming down really fierce with interest rates here with the 10-year yield? Now we're just fiercely going back up. This is what's causing some of the concern in the market right now. If this keeps going up, that might mean that there's something weird going on here. We need interest rates to try to stabilize. And we were really going up with the 10-year based on price. Now we've been coming down with the 10-year based on price. We're no longer inverted. We're at a plus +0.2 here, but we'll see if it can stay that way. And then we saw some improvements with our growth to value ratios coming back up to the moving average with the Qs to S&P. Actually came down to the moving average with discretionary to the S&P. We crossed back above the moving average, but the moving average is declining when we compare large cap growth to value. And so an improvement with the large caps, mid caps, and small caps. So there were improvements here, but it needs to be more than what we've just seen to turn things back positive. All right, so what's our outlook? We're still negative in the short and intermediate term, and we're mixed in the long term as measured by moving averages. We're going to get initial jobless claims and CPI. These are two pretty influential reports, unless the market's going to freak out about what's going on in Japan or Europe or what have you. And then all the stuff that's going on these days with mainly the trade war is what's really going on there. We're going to get PPI and consumer sentiment on Friday. Here's a look at the calendar and what the forecasts are for CPI. Seasonality, we're neutral to positive with the Dow for April 10th, where we're just flat out positive with the S&P and Nasdaq, but the market really hasn't been following seasonal tendencies now. So there's some positive action here before we tend to chop a little bit sideways after this, but the market's kind of doing its own thing right now and not really sticking to seasonal norms. And this also shows that April is usually one of the better months, but so far it's not really working out that way, even with the improvement that we saw. So we're now looking still negative with our McClellan oscillators and summation indexes. The parabolic SAR is still negative. We're still negative with the momentum oscillators, the bullish percent indexes. All these charts are improving, but they're still negative. And we're still negative with the Swindon trending oscillator, our moving average studies, the ease of movement, money flow, ultimate oscillator, and vortex. And then I didn't show this chart. That's the long-term special K oscillator continues to be negative. And the momentum is improving for the NASDAQ 100, but still quite negative. Now on the positive side, we're looking better here with our smart money indicators. And we're still positive longer term with our growth to value ratios, but we're going to lose that for the S&P if we don't get back above those moving averages there. And we're still negative in the short term, although improving. The financial sector saw a pretty good day, and it's showing some improvement there, but the bank ETF is still below its 200-day moving average. And we're working off of signals here with the mass index and the Pring bottom fisher. So our conclusion, we're still negative in the short and intermediate term, mixed in the long term, and right now this just looks like an oversold bounce. We need to see more follow through there. We are improving in both the short and intermediate term, although we're still negative and we continue to be mixed in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.